Hello, and welcome to We Hate Insurance. I'm getting ready to do the live presentation at a library locally about auto insurance. So I thought maybe you would like to see the presentation beforehand. It gives you an idea of what to look for in a policy and how to save the most money. So we're calling this hacking auto insurance. How to get the best deal without losing important coverages. And we're doing a bonus section to talk about claims and how to file a claim, what to expect with a claim, and all that kind of stuff. So here we go. Um, just a little bit about me. I don't think we've done this before, but I was first licensed to sell insurance back in 2008. I'm licensed to sell life, home, commercial, health, and of course, auto insurance. I am licensed in 3 or 4 states currently. I've got 4 daughters, 2 granddaughters, 2 grandsons, and altogether I've paid for 5 sets of braces, and one of my children didn't even have a set. So that's a fun fact about Jason. Every morning when I get out of bed, I'm a 5 foot 9 inches and 1/4 tall. And when I go to bed at night, I have lost a 1/4 inch every day. So another fun fact. Okay, so here we go. This is the objectives. I'm not trying to sell anybody anything, just deliver information that you can use. I want to talk about the 5 basic auto coverages and how they help protect you. I'm going to give you an overview of how companies underwrite auto insurance and give you the best price and how to get you the best price possible for your situation. And I'm going to present additional coverages that you may need or might just want. And we're going to discuss how to make an auto claim, what to expect from the insurance company, and what to look for yourself. Excuse me. So here we go. 5 basic coverages in auto insurance. First is bodily injury, affectionately known as BI. Now, you'll hear a lot of people go BIPD, as PD is the other part of the most basic liability coverages, and that is property damage liability. MedPay is another basic coverage, and we're in the state of Indiana, I might mention, so there is slight differences across the nation in the 5 basics. But for the most part, these are going to fit most states' situations. Comp or comprehensive, that is coverage that is a basic coverage, and then collision coverage. So these are the 5 most basic types of coverage that you'll find. Um, let's explore them just a little bit in depth and talk about what they cover and why they're important. So bodily injury liability pays for injuries or death that you cause in an accident. If it's your fault, your responsibility, it's going to pay medical expenses for the injured parties, lost wages, in some situations, legal fees. So bodily injury is really important in terms of your liability. And if you're in an accident, that's one of the most gut wrenching things is if you're responsible for it, somebody else getting injured. You want to make sure that you've got enough to pay for that. Um, 2 basic ways that this type of coverage is structured. It is either a split limit, which means per person and per accident. Split limits, really common ones across the Midwest are 100, 300. You'll see a lot of that. And that means $100,000 per person up to $300,000 per accident. So split limits limit the amount of coverage that an individual will have, and they limit the total amount that is offered for the accident. So if you had 6 people in a vehicle and each one of them had $50,000 in medical fees, you would have them covered. If you had 3 people in the car and their first person's medical fees were 200,000, you'd only have 100,000 to cover that first person's injury, so you still would be liable for whatever's above that. So something to think about. Make sure you've got plenty of coverage there. There's also something called combined single limits. It is just what it sounds like. It's one limit for all liability coverage, and that covers bodily injury and property. So you could have 300,000 in combined single limits. You hit somebody with a really expensive car, um, you know, you don't injure them at all. So you've got a lot of money to go towards that property damage. Or vice versa, you hit somebody that has a really crappy car, you need a lot more coverage for the bodily injury. So it's a little more flexible. There's benefits both ways. So let's talk about property damage. Now, property damage, it covers the other automobile if you're at fault again, because this is liability coverage. It covers the people that you hit. And it's any property. It doesn't have to be an automobile. You know, if you hit somebody's house, it would help pay for that. It's going to pay for fences, any kind of other structures. If it's a collision, that it's going to pay for that. So again, there's two options. There's the split limits, which typically with and when we talk about split limits, you're going to have a single limit for property damage. It's not like per vehicle per accident, like with bodily injury is per person per accident. This is going to be in total, but the split limit would be split limits on the property damage or on the bodily injury with how much you're going to get on property damage. So a very common one would be 100, 300, 100,000 per person on bodily injury, 300,000 per accident, and then that $100,000, that's the third split limit on the equation, and that would be 50,000, 100,000, and that's what you've got to cover the property damage that you have caused or you're responsible for. Now, in combined single limits, you can have again $300,000, and then that covers all liability, bodily injury, and property damage, and it's just one lump sum of money. It's one big bucket. Pull out of it whatever you need. It's more flexible, but there are benefits to the others. And when you limit the liability of the insurance company, their stake in it, as it were, typically you'll see some lower rates. That's not always the case. Every company has their own equation for that. So it's really personal preference. A lot of times you'll see $1 million combined single limits for commercial vehicles. That gives them the most flexibility. So they tend to go with that. All liability coverage is there to protect your income and your assets. So if your levels are lower, if the amount of coverage you have for liability is less than 2 years of your annual salary, plus the value of all your assets, you're not covered enough. So if you have a home that's worth $300,000 and you make $70,000 a year, you want liability coverage that's going to cover you for nearly $500,000. And that's because that's what you can be sued for, and be found, to have to replace. So the more income you make and the more assets you have, the greater your risk in terms of liability. So be sure and address that with an agent. We always talk about keep it, whenever you're looking at these things, you want to have a live agent, somebody you can talk to that will, help you with these decisions. Let's take a look about what's next. That MedPay. MedPay's a lot of times people are like, I don't need MedPay, and they try and shuffle it off. It's not a very big expense. It's a very small expense in the policy, and it covers medical expenses that result from an auto accident, regardless of whose fault it is, and it's generally speaking for you and the people in your vehicle. Some companies will even award MedPay as a death benefit if someone in your vehicle dies. That MedPay can cover them, their final expenses. Excuse me, it can cover doctor visits, hospital visits, surgery, x-ray, ambulance fees. Sometimes your co-pays for health insurance and these additional services are not covered. So this is showing that you can use this money as a little bit to buffer that and take the sting out of what can be an expensive instance. And let's say it's not your fault, it's not the other person's fault, it's like a no-fault accident. This MedPay can still pay out and cover those medical fees, God forbid, funeral fees, things like that. Keeps it from becoming a real issue for you and something that could, cut into your lifestyle quite a bit. So, let's see. Let's go to another optional coverage. This is called comprehensive. So, comprehensive coverage is what we call other than collision. Um, and I like to go through this first because a lot of people don't understand that these are two different types of coverage. If you have an accident and you hit another person or a car or a building or a fence, that's a collision. But if your vehicle's stolen or vandalized, if there's a fire and your vehicle gets caught in a fire or an explosion or a flood or hail or even a tornado if you're in the Midwest like me, uh, falling objects like a branch off a tree, the tree itself, um, animal collision when you hit a deer or a turkey, which has happened to me, glass damage or breakage. You're rolling down the road and a coal truck rolls by you. He's not tarped like he's supposed to be, and that comes out, hits your windshield, and cracks it. That's all covered under comprehensive. So comprehensive gives you coverage for anything other than a collision, and typically there's a deductible for that. You can set that deductible whatever you want. There are some companies that will mandate certain deductibles, but the deductible is what you owe, and everything else is covered by the insurance. So if your deductible is $500, the first $500 of damage is out of your pocket, and then the rest is paid for by the insurance company. So that's comprehensive. Now, the second optional coverage is collision. Collision is just what it sounds like. It's when you run into something. And collision is if it's your fault, typically. If you hit something with your vehicle and you have collision coverage, it's going to pay for it. If somebody else hits you, their liability coverage will pay for your vehicle. So this can include, hitting another vehicle, hitting a stationary object, guardrail, building. One of the most common things that happen is at car washes or gas stations where people have posts in the ground. Some folks will turn too quickly or back up and hit those posts. All that's included under a collision coverage. A single car accident, rolling over, you hit a patch of ice or a patch of water and hydroplane and flip the car over. That's going to be covered under collision as well. Sometimes even hitting a pothole, if it's big enough and does some damage, that can, in some cases, can be considered collision as well. So again, you're going to have a deductible with this. Typically, that means your share of it is whatever you've set the deductible at, and the insurance company pays the rest. Now, if the value of the vehicle is less than the claim coverage, then you're going to have something called, a totaled vehicle, and we'll talk about that a little later under claims. But typically, if the repairs are less than or more than the value of the vehicle, they're going to go ahead and repair it. All right, other coverages, gap coverage. Ooh. So let's say you bought a new vehicle, and I know everybody's heard this. You drive it off the lot, and it's instantly worth less than you paid for it. So if that is true, then you need to have gap coverage. Gap coverage will pay the difference between the two. So if you roll off the lot in the first couple of years before the value of the vehicle is equal to or more than what you owe on it, then it'll pay the difference. So it's called guaranteed asset protection. Pays the difference between what you owe and the loan or the lease that you have on it if it's totaled or stolen. So that protects you against that upside down in being upside down on the loan. And it happens to everybody. You buy a new vehicle, that's what's going to happen. If you buy a used vehicle, typically you don't need gap coverage. Once your vehicle is old enough that the value is caught up with the amount you owe on it, or you paid it down enough, then you can get rid of the gap coverage. Gap coverage typically is pretty inexpensive on your policy. It's also, if you get a loan on the vehicle, a lot of times the finance company will offer you gap coverage. I suggest that you compare the cost of the two, see which one's cheapest, and go with that because they cover the same things. All right, next one is uninsured motorist and underinsured motorist coverage. It protects you if you're in an accident and somebody hits you and they don't have insurance. 1 in 4 drivers in the state of Indiana have no insurance on their automobile any given time that they're driving. That could be, they get payments cut, they had a job loss, they really, really needed to go see a concert, and so they pulled some money from what was supposed to go into auto, or whatever the case may be. At any given time, 1 in 4 drivers on the road is uninsured. So this coverage is a good one to have because it'll protect your asset from someone else's lack of responsibility. Rental car reimbursement. If you have a covered accident, so you've got comp and you've got collision or one or the other, and you have a covered accident, rental car reimbursement will reimburse you for the cost of a rental car while that settlement's being handled. So that can be, if it's totaled out, once the insurance company gives you that final payout, then of course your rental car coverage will expire. Or if you have to take it in, drop it off the shop and leave it there for a week or 2 weeks sometimes, then that rental car coverage comes in really handy. That'll get you to and from work while your car's being repaired. Great coverage, usually pretty inexpensive. Generally speaking, we're talking less than $40 a year for most companies for like a $40 or $50 a day benefit. Hired and non-owned auto is a type of coverage typically reserved for people in business, people who typically will use vehicles for work-related tasks. They'll have employees that will use their own cars. It covers bodily injury or property damage to others. It doesn't cover damage to the vehicle being used because that's going to be covered by the vehicle. So, but typically in regular policies, if you're using your vehicle for work and it's not designated as such as a business vehicle, then they can deny the coverage. So this hired and non-owned, if your boss says, hey, drive across the street, as long as he has hired and non-owned auto, you're covered for the liability coverage if you hit somebody under his policy. So good to know stuff. Now, we get to the good stuff. How does the insurance company underwrite it? Underwriting is just trying to figure out if you qualify for auto insurance, and if you do, what premium does the insurance company charge? That's what underwriting is all about. It's deciding if you qualify, and if you do qualify, what are they going to charge you? And this is based on a lot of things. They have similar processes, but they weigh different factors differently. Every insurance company has an avatar, somebody, some imaginary person that makes up their perfect customer. And so some companies like young people, some people like old people, some companies like people in between. Age, though, is certainly used as a factor. Under age 25 and over 75 can definitely be a factor in the cost. Gender. Females typically have fewer accidents, especially in the younger category, especially under 25. Um, Moving violations. If you have too many moving violations, the company won't even issue a policy to you. So, and moving violation is not a seatbelt ticket. It is, speeding, reckless driving, um, you know, not stopping at a stop sign, those kind of things. Now, auto insurance also uses a type of scoring called insurance scoring. This is weighted heavily on your credit score, and they just use different data from that insurance score or the same data in a different way. So you can have a perfect insurance score or a perfect credit score, and your insurance score still be a little bit lower than there. But in general, if you've got a good credit score, your insurance score is going to be pretty good as well. So how do you get the best price? Well, the obvious is maintain a good credit score. Um, do things that will get you a better credit score. Look at too much open debt. Look at frequency of payments. Make sure that you pay those on time. Pay off the ones that you can and get those, closed out on the books. You want to make sure that you have a little bit of open credit, but not too much. Just the things that would keep a good credit score. Drive defensively. Yeah. Avoid accidents. Don't get so wrapped up in getting somewhere so fast that you're taking chances and risks. Don't go fast. Don't try and cut people off. Don't get angry when people cut you off. Let it go. Be defensive in the way you drive. The less accidents you have, the better your premium's going to be. And that goes right along with don't speed. Don't speed, don't drive reckless, none of that stuff. Drive like your grandma, as long as she wasn't a reckless driver. Now, higher deductibles means lower premium. You can have your agent, play with the deductibles and see what your premium comes out as, but that'll help control that premium as well. The more risk you take, the lower premium the insurance company is going to charge you. So if you're going to take a $1,000 deductible, insurance company is going to take that into consideration. They're going to go, well, if he blows out a window, from a rock flying through, he's going to pay for most of that, if not all of it. So that's less risk for the insurance company. And again, buy older cars and just get liability on them. Buy, hoopties from off the side of the road for a couple grand and keep it running. And then just put liability on it. That physical damage coverage, that comprehensive and collision, is some of the most expensive coverage. And so to control that premium, especially whenever you have a lower income or you're just getting started in the world, you want to have older cars that don't need physical damage coverage. If you run into somebody or somebody runs into you, if it's wrecked, you roll on and get a different vehicle out of pocket. Don't buy expensive vehicles and expect the premium to be low, because when you protect it physically, we have to protect it based on the value of that vehicle. All right. Let's talk a little bit about youthful drivers. We're getting to close to the end here. Who is a youthful driver? Anybody under age 25, generally speaking, is considered a youthful driver. Some companies have adjusted that a little bit, but 25 is that age where the risk for the insurance company goes down. It also can apply to drivers who have less than 6 years of experience, even if you're over 18. Sometimes drivers under 30, if they just got a license and don't have an insurance history. Now, I live in a rural community, so this is not really a big thing in rural communities, but in cities, a lot of kids have put off getting a license until, they're in their 20s and 30s, because there's no need. They have public transportation, and then they decide, hey, I want to drive. And they get a license. We're going to treat them like they are a teenager, because essentially they have the experience of a teenager in terms of driving. Why are they considered higher risk? Well, statistically, you're going to be in more accidents. I've had clients who've had children that have gotten in 4 accidents before the end of the first term. That is a 6-month term on the policy, 4 accidents. And I've had 4 teenage drivers in my household at the same time. I know they're risk takers. You know, they're likely going to be in more accidents. They're likely going to engage in more risky behavior like speeding, distracted driving, you know, on texting on there. They're going to be talking to their friends, listening to the radio, all that kind of stuff. So they have less experience. So once they get into a situation where they have to avoid an accident, they don't have the experience to do that. So typically you're looking at 2 to 3 times the price of a seasoned adult over 25 for the same useful driver. You just have to expect this. This is why I said buy a beater, buy a hoopty off the side of the road, and only put liability on it, and that's what you want to put your teenagers in. That a lot of times they're perfectly safe cars. Make sure they are safe and they operate well, but don't put them in a nice car. Put them in something that is, going to allow you to manage that premium. If they're in an accident, don't give them a car right away, and don't give them a second one for sure. It's going to limit their eligibility for low risk insurance programs. Some programs are designed for just that middle of the road driver that got some age on them, no tickets, no accidents, good risk. They're not going to be eligible for those. They're going to have fewer discounts. So, those kind of things, that's just a part of being a useful driver. They could also have surcharges if there's infractions, and those surcharges might be higher than if they were older. So, all those things can be a part of it. Around age 25, premiums do tend to decrease pretty dramatically, and some companies kind of taper that, starting at age 20, 21, but pretty dramatically at age 25, you're going to see those go down, as long as you keep a clean record. Now, here's your bonus section. We're going to talk about making a claim. How do you make a claim? Well, there's all kinds of claims that you might need to file, right? First, a comprehensive claim. The garage burns up. The house policy does not cover the automobiles. Automobiles have their own policy. So if you don't have comprehensive and the house burns up or the garage burns up and burns up the car, then you don't have coverage. So comprehensive coverage is one type of claim that you might have to have. It could be lightning strike. It could be you hit a deer or a turkey, like I said. Collision liability, you damage somebody else's property, you might have to make a claim on that even if it's your responsibility. Collision physical damage, so if you hit something or somebody hits you, you might have to make a claim on your policy for that if you have that particular coverage. Collision physical damage, if it's not your fault. There are times when people don't have coverage, or don't stick around, hit and runs, things like that. So you may still have to make a claim on your policy to get your vehicle repaired. Uninsured and underinsured motorists, if they do stick around, they don't have any insurance or they don't have enough, you may still have to make that claim on that particular coverage as long as you took it out, remember, because this is an optional coverage. Now, when you file a claim, your insurance policy, on your insurance policy, it's going to be determined to be your responsibility. You only is paid if you carry comp and collision, okay? If you're at fault and your vehicle gets damaged, you're only going to get paid if you carry the appropriate coverage, which is that comp and that collision. Damage is based on repair costs, less your deductible. Usually you can use any shop that you want to get repairs. The industry's really gone away from mandating that you only work with the shops that they work with. Most companies will allow you to go anywhere. If the repairs are more than the value of the vehicle, you'll be paid a depreciated value of the vehicle. That's ACV, the actual cash value. It's a little bit different than the Kelly Blue Book, and it's a little bit different than you'll pay um, um, at the dealership. So, be prepared. If it's your fault and your responsibility, then you get the depreciated value, which is going to be less, and you're not going to be able to purchase the same vehicle for that price. Now, to calculate the ACV, actual cash value, you're going to subtract depreciation from the replacement cost. Replacement cost is how much it would cost to replace a car with a similar make, model, year. Depreciation is the loss in value due to factors like age, mileage, and condition. And they're going to look at all that. They can tell if you have 12-year-old rust on your car, even after an accident, they're going to be able to tell that that's a part of the condition. So all the liability payments to people you injure, the property, it's going to be handled by an insurance company. You're going to give them the authority to act on your behalf. So you're not going to be involved in that. You're not going to make a decision on that. If the insurance company determines it's your fault and your responsibility, they're going to make those payments on your behalf, and you have signed that away to the insurance company. You've given them the authority to do that. That's important to remember, because you can't make decisions on how that claim is handled once you've done that. Now, this last little bit, it's unfortunate, but sometimes this is going to increase your premiums. Maybe a little bit, maybe a lot. Depends. Depends on the company, depends on you as a person, depends on your demographics. Just expect that you're going to see a somewhat increase in your premiums for the next term. So now, on to happier things. What if it's not your fault, right? So you file a claim, it's somebody else's fault because it's been determined to be their responsibility, right? The damage paid is based on the repair cost with no deductible. So that's good, right? Your deductible doesn't apply to their policy. Usually you can use any shop to get the repairs done just like you can with your own policy. Usually you're going to get a rental car regardless of if you have that on your policy or not, because we're using their liability to pay for your vehicle. So always ask for it. If your car can't be used or it has to be in the shop for a repair, you need a rental car to get around. That's reasonable, and you can, a lot of times you need to ask for those kind of things. If the cars are more than the value of the vehicle, you'll be paid the value of the vehicle. Now, to calculate the replacement cost, the adjuster is going to find the amount that would replace the car with a similar one that's a reasonable distance from you. Reasonable distance is, it's different for different companies. 100 miles might be reasonable, 50 miles might be reasonable. Ask the adjuster. Ask the adjuster all these questions that you have. What's reasonable distance? And if you disagree with them, you can do the research yourself. You might go a little further out. You might say reasonable distance is 200 miles. And you can say, hey, look, I found one. I found several that are a little further out, but they actually show what my vehicle is worth. You want to do that if you're going to try and get a little bit more out of that policy. Make sure that you've got enough to replace your vehicle. Usually it doesn't affect your premiums. So that's a good thing. It's a bonus, right? If it's their fault. All right, state minimum limits. Why not just get state minimum limits to save money? Boy, look at that. That statement there, that's a really common one. People say this all the time. Well, here it is. State minimums are known as financial responsibility laws. They're meant to make sure you have enough resources to pay if you hurt someone or damage their property. Every state's different. They all accept different limits. They all accept the limits from the state you're licensed in as equal to their limits in terms of the law. So, for example, someone from, I don't know, maybe California, which has much lower liability limits, drives into Indiana. If they get pulled over, their liability limits that are legal in California will be considered legal here. In Indiana, state minimums are 25, 50, 25. 25,000 per person on bodily injury, 50,000 per accident on bodily injury, and 25,000 on property damage. Florida state minimums are 10-10. Yep, you heard that right. So your cousin drives up from Florida, they got 10-10, they get in an accident with an SUV that's worth $75,000. How much do they owe? Their insurance company owes 10 grand. All right, you're still going to be liable for any damages that are over and above the minimums that you have. Don't do it. Okay? You will lose. Just imagine if you had state minimum limits, you hit a school bus, the insurance company only has to pay a total of $75,000. At $25,000 per person, up to $50,000 per accident for bodily injury. So the school bus got, say 20 kids on it. So each one of them goes to the emergency room. It's $5,000 per person. Do the math. That's already, a big chunk of your bodily injury just for them to walk in the door and get checked out. So that just is an example of how you can quickly eclipse what state minimum is going to cover for you. So let's wrap this up. There's no wrong answers. Car insurance, no matter what anybody tells you online, is not one size fits all. It's not. You need to talk to a live agent, make sure that they help guide you into what you need. Re-explain these things. You're not going to remember most of what I told you today because you're not licensed for it. You don't have to do continuing education for it. It's not your business. But it gives you an idea of where to start. And, if you go with a licensed agent, it's not going to cost you anymore. It's that you just get free advice, and they get paid by commission, of course, but you get free advice from a live professional who's going to help guide you into what you need. Improve your credit score if possible. Limit the number of claims that you have. Accept more of the responsibility yourself. Don't speed. don't get moving violations, and drive defensively. So, and that'll help get you the lowest possible price. Make smart choices when you have youthful drivers. Keep them safe, but go with an old car. Don't do comp and collision on it. Tell them that if they wreck that vehicle, they don't get another one, and stick to your guns, because that will keep them safer longer, and it'll help them know that, if they get into an accident, there are consequences, and it'll limit the premium that you're paying out. So that's it for this episode. I am so glad that you joined us. It was a little bit longer than we normally do, but I hope you appreciated all the great graphics that we came up with, and we will talk to you again later. Hopefully this will make insurance suck a little bit less for you. Take care and have a great day.